Welcome back. Well, for the markets, it is weak, so down around 100 odd points currently for the Nifty. Good time then to have a conversation with Nilesh Shah, MD Kotak Mahindra Asset Management, joins in now. Nilesh, hi, welcome to the show. Well, we just spoke to you around 2 weeks ago, and at that time we were talking about the inflows that we saw in the previous month, the SIP inflows as well. At this point, we're sitting at a point where the 25% additional tariff is going to come into play tomorrow at 9:30 a.m. What's your sense in terms of what the impact could be to the economy?
Undoubtedly, there are sectors which will get adversely impacted by 50% tariff. A 25% tariff hit is on the volume and margin. At 50%, it is trade embargo. Sectors like aquaculture, textiles, chemicals, auto components will have to find other buyers. They will have to find other markets. And government also will have to step in to either provide them credit or some sort of incentive to survive this down period. Undoubtedly, tariffs will have impact on certain sector. But is it a death knell for Indian economy? Answer is no. By stimulating our domestic economy, and we have already taken steps by talking about GST rationalization, the overall impact on economy can still be managed.
Right. So overall impact on the economy can still be managed no more than about 50 basis points in terms of a GDP hit is what all the experts are saying as well. But Nilesh, the question is, what about EPS growth in general? There was an article this morning as well. It said that the Nifty is not likely to see an EPS growth of over 10% in FY26. And this at a time when we're trading at valuations as we are, makes it a lot more unfavorable for a lot of the foreign institutional investors to invest in our market as well. Like we were speaking about 2 weeks ago, the domestic inflows have been at a record high. What's also important is that the FII ownership is at a near record low as well. What do you think will change the favor or tide in favor of India from an FII flow standpoint?
So let's remember that many of the FPIs are underweight India. They are also short India as derivative positions have confirmed. Are you expect them to say that India is a great market when we missed out the opportunity? I don't think so. They are bound to say that India is an expensive market, FPIs are selling, why are domestic investors buying into this expensive market? Everyone talks based on their position. Let me give you some data. In 6 years or 5.25 years of this decade, FPIs have invested 3,45,226 crore. 3,45,226 crore. Of course, some money has come from equity, roughly about 1,28,767 crore. And some money has come from debt, roughly about 2,14,290 crore. So please remember, data is showing one thing, positions are going to say another thing. Now, people are talking about slowing profit growth. Is this 10% profit growth for Nifty suddenly discovered? Or was it available 6 months ago, 8 months ago? Answer is, the first quarter results at about 8 to 9% growth in Nifty and higher growth in mid-cap was as per the expectation. Markets are driven against expectation, not on just absolute number. Yes, India's PE premium is higher than all the peer group, but we deserve that valuation premium because our governance is better, because our earnings growth over longer term will be better. So we have to differentiate between facts and opinions which are driven by position. Do we believe markets will deliver returns like last 5 years? Answer is no. Last 5 years have delivered exceptional return. Returns will moderate. Will there be volatility and correction? Undoubtedly, yes. But if you are investing for long term, India is still a market where you can invest, provided you can withstand the volatility.
Okay, long-term story still stays intact, right? If you can wither the volatility, it's fine. Nilesh, what about overall earnings growth, at least in FY26 now, right? Q1, we managed that 8 to 9%. But Is that something that is going to be a doubt now? And then should one only look at domestic-facing companies as of now?
So market obviously keeps on discounting news. Now, the tariff will come and hit our economy. But isn't that discounted into the market as market was cognizant that these tariffs are coming? The government is taking steps to stimulate domestic economy. In terms of top-down macro, India is one of the most stable macros in probably the whole of world. Inflation is in low single digit. Growth is in mid single digit. Fiscal prudence is visible. We are the only major economy in the world which has reduced its debt to GDP ratio between subprime crisis to COVID crisis. So our top-down is still good. And yes, as tariffs have been levied, it will make sense to invest into domestic-focused economy rather than companies which have direct exposure to US.
Right. And do you think the tide has turned from capex to consumption, given the push from the government, not only in the budget, but now the Prime Minister's speech on the Independence Day as well, on account of GST rationalization? Tomorrow starts Ganesh Chaturthi. Also, the festivities begin. All these factors imply that consumption looks a little better now than what it was earlier?
So we have been saying for some time, thanks to the income tax rebate, potential GST rationalization, potential petrol diesel price cut, as well as reduction in interest rates, which helps reducing EMI burden on borrowers, and finally, eighth pay commission coming into play, consumption will outperform the market. However, within consumption, you have consumer staple, which are unlikely to outperform the market. And then there is consumer discretionary space. In simple language, as your disposable income goes up, you're not going to buy more soaps and shampoos and detergents. You are more likely to spend this on experiences. The sixth pay commission was more for automobiles where entry-level cars took off. The seventh pay commission was more for consumer electronics and stuff like that. Eighth pay commission, who knows, it could be for experiences like home improvements, traveling, tourism, education, healthcare, airline, and so on and so forth. So we will be positive on consumer discretionary space rather than consumer staple space.
Okay, all right, Nilesh, thank you very much for joining in and speaking with us. So that is Nilesh Shah talking to us about the 50% impact of the 50% tariff impact which comes in to play tomorrow, and domestic focused stock sectors would be something that he is saying one should probably look at. We'll take a short break, but we'll get you more on the markets, lots more stocks in focus on the other side.